Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. In this clip, we are going to be looking at ratios, and what do ratios tell us? They tell us value, relative value. And it's an asset priced against an asset. And then we look at it through history. And what assets do over time is they just go up and down against each other. And if we can identify the cheap assets that are improving in value, those are the ones we want to be invested in. So you buy the cheap, undervalued assets, you sit in those assets, you wait for them from an undervalued state to an overvalued state, and then you swap that asset to another undervalued asset when that one becomes overvalued. And then you just swap between assets over time from undervalued to undervalued assets. And you can make dramatic gains, not just little bit gains. Dramatic gains, because a lot of these are not dependent on inflation or deflation. All you're doing is you're playing the ratio back and forth. And what that allows you to do is you increase your purchasing power against other assets. So if you're in an undervalued asset, at some point that asset, people will direct money towards it and it will become overvalued. And that's what history suggests. Anything that's basically an anomaly in history, something that gets mispriced, will price itself and write itself against other assets over time. And I'll show you exactly what that looks like in these charts here. So let's dive in. Let's look at some of these ratios, and you guys can get familiar with using ratios and in value. So in the upper left here, I've got the gold to oil ratio, and this is a long-term chart. That goes back to 2008. And just to generally speak, a cheap oil price against gold is anything above about 25, 30. But I'd say between 25 and 30 is a really cheap price in history. A very expensive value would be anything under 10. 10 is a very overvalued state. In the last commodity bull market, we got all the way down to like 5. So it's under 10 here. And we got to an anomaly, which we went over 50 all the way up to almost 100 in 2020 during that crash. And we've been steadily moving lower in the gold to oil ratio. And what we've done recently is we could have broken out, and we did break out. I'm going to see if this thing holds and starts to compress even further. But we broke out of that gold to oil ratio to the downside, which means that oil is outperforming gold. And I think what's going to happen coming up is gold's going to start to move higher and oil is going to move up at a faster pace. That is a potential that could happen, where we see oil really start to take off. And I know people are probably thinking, well, oil has already taken off. It's been moving quite great. Well, we haven't really even broken out of this uptrend channel. We're just starting to break out of it, which means that we're going to see a vast outperformance of oil. We could see a big move. And that's one thing I'm watching. But the ratio's at 21.45. It's getting a little bit more expensive. Some of that value is getting eaten up. I would say it's not at a super undervalued spot anymore. We're starting to get more towards a fair value. And the average is more like 15. So it's still cheap, but it's not as cheap as it was. Looking at it from a short-term perspective, zoomed in, here we are zoomed in, and we're coming on down. We got in this channel here, and we broke to the downside of that channel, and we're continuing to compress that ratio, which means that oil is outperforming gold, and it's doing very well. Now, looking at the CRB to S&P 500 ratio, what this means is, and what we're doing is we're breaking the downtrend line right here. Here's the downtrend line. We broke it to the upside. Means that the CRB index, commodity index, is outperforming the S&P 500. And we are at incredibly low valuations in relationship to history. History at the end of the last commodity bull market got all the way up to 0.38, 0.4, somewhere in that range. And we're at 0.05 right now. We broke the downtrend, and if you zoom in, we broke another pattern recently, which here's your pattern. That's down here in this little corner. We broke this pattern to the upside. We break it. We always come back and do like a retest, back test. It probably won't pull all the way back. And then we're going to take off again. What this means is that we should be in commodities, not in stocks. And that commodities will most likely increase its purchasing power against the S&P 500. So that is that there. Looking at some of these other ratios, copper to gold ratio. The copper to gold ratio broke to the upside. We're coming back and doing a back test retest, and then I think we're going to see it move on higher. So copper's outperforming gold as well. What that means is that the economy is, we'll call it strong. So usually what it tells us, that we're having inflation, inflation's in the system, and that a commodity boom is coming. The platinum to gold ratio. When platinum outperforms gold, what that means is that the market conditions have changed. That we're going to probably have a commodity bull market, and that stocks are a spot where you don't want to be in stocks when this platinum to gold ratio is moving up. We do have platinum outperforming gold. I think this is going to continue going forward. And I'm a big investor in platinum because platinum is the cheapest metal of the precious metals. So in this ratio, I suspect that this ratio is going to continue to compress and move higher, meaning that platinum is going to outperform gold in the future. Looking at the gold to silver ratio, we were moving on up, which means gold was outperforming silver. For a little while, we were in this channel, and then we just broke to the downside, meaning that silver is going to outperform gold. I suspect silver to outperform gold over this next bull market. And during the commodity bull market, towards the end of it is when silver really starts to take off. So silver is one that I own, and I own some of the small silver mining companies. Now here's gold to palladium, and during a commodity bull market, gold outperforms palladium. Palladium is the one that goes opposite of all the other metals. So I am not owning palladium. I think platinum will do better. I think silver will do better. And I think gold will do better than palladium. But you can see gold outperforming palladium at the moment, and the ratio is compressing in favor of gold. Looking at the gold to palladium ratio on a big long-term perspective, we broke out of this pattern here, moving on sideways. Palladium really started to compress against gold, meaning that palladium was outperforming. We broke the downtrend line just recently, where I think gold's going to outperform palladium. And this is the big long-term picture that you can see. So I think gold's going to be the spot to be in relationship to palladium. Platinum's really the one, and this is another chart here. This is the platinum to palladium ratio. Here is the downtrend line just recently. We've got higher lows stepping in here. We are going to break to the upside here probably pretty soon, signaling that we're in a new uptrend, that platinum is going to be outperforming palladium in the future here. And we are at incredibly low valuations for platinum, meaning palladium is really expensive and platinum is incredibly cheap. I've never seen I don't think the ratio has ever been this low in history. So I've been buying platinum, physical platinum, the stuff that you actually hold in your hands and will swap in the future, far future. Might be 5-10 years. Usually it might take as long as this move downward is upward, and really increase my purchasing power against all the metals and other things in society, like stocks and whatever else. So this is the oil to S&P 500. This is a big chart here. So the top was about right here. I drew it all the way down, and we're just breaking to the upside, where oil is outperforming the S&P 500. I'm a big oil guy, and if I were to price like SM Energy in relationship to the S&P 500, SM Energy is going to be vastly outperforming stocks in general. So I'm looking at oil to continue to outperform the S&P 500, the actual commodity itself. And then the oil stocks are going to be an absolute winner over time. So we're seeing that oil outperform the S&P. Looking at copper in the S&P 500, we had this downtrend break, and then we had another downtrend break just recently. And I think we're going to see copper outperform. the S&P 500. And then anything that's copper related or the diversified mining companies are more than likely going to outperform the S&P 500 as well. So that's another even more data where commodities themselves are going to start to outperform the S&P 500. We've got the dollar here. The dollar is getting weaker in a commodity bull market. What you'll see is a decline in the dollar index, and we're seeing that decline just starting to happen. We've been in a little bit of an uptrend here just recently, past year or so, and then I think we're going to see it decline again. And then we've got the 10-year yield. In a commodity bull market, interest rates lag inflation, and we just started to get inflation. Interest rates are starting to come up a little bit higher. Here's the downtrend channel that I drew. We broke out a little bit in 2018, came back and declined for the COVID crash, and now we're heading back up. And I think we're going to see higher interest rates. How high? Not exactly sure, but this is market driven. They're probably going to try to buy it down with yield curve control in the future, which just means you're going to get larger and larger real negative rates and have a problem where nobody wants to buy bonds anymore. It'll be 100% artificially supported and purchased. And then I also have uranium priced in gold grams. This is a chart courtesy of Camco for September 2021. Last bull market, we saw a huge compression of uranium in relationship to gold. And we went up to a ratio that was maybe about 6.5 or so. Coming on down, we are coming into this pattern. We just broke to the upside of it. That's what this little corner is. And we may be at 0.75 or so, and we could get all the way up to maybe 6.5. So what that means there is uranium, the price of uranium, if we were to go back to the highs, divided by, let's say 0.75, uranium could go up 8.66 times where it is today, and let's just say it's at $40 to make it easy. Uranium could go to $346 per pound and match what we did last bull market. That's roughly the price, 350, 300 and something. And that's what I get for an oil price as well. So I think this is a high likelihood of actually occurring over this next bull market. Now, if the ratio, and I'm going to talk about pounds per ounce because that's what I'm more familiar with. If we get to, let's say gold goes to $3,000, and I'm going to divide it by, a low is about 4. So if we go to 4, that gets me at $750 per pound. And I think that the high likelihood is that we're probably going to meet somewhere in between those two numbers, and it could even go higher than this, if depending on what gold does. And that's just an inflation-adjusted measurement. So in uranium, I think we could go anywhere between $300 and $1,000 a pound. That's kind of my guess, if I were to take a guess. And if we're in this energy crisis that's coming, it could go even more if they start flicking on nuclear power plants again. And everybody starts to run at uranium saying, we need to buy more uranium. And we could get in a weird scenario where we soak up all of the world's inventories. We kick back on the uranium mining, all the mines, and then the demand will still exceed that supply. And then we have to wait for new supply to come on. And that gap there where we're waiting, that's where we get all the bidding wars. So that will be an interesting time frame. Maybe that's a few years out. So that's what I'm waiting for. That's where the fireworks start to go off. So I'm positioned in a lot of this stuff here. My favorite investments, physical platinum and silver, are the two that I like a lot. I think it's a lot of leverage there, and a very low risk. So physical platinum, physical silver. I like tin, copper, and I like all the energy sector. Energy sector historically has more leverage than the base metals. So I've been heavy in precious metals and energy. That's where I'm heavy, and I do own some royalty companies and some diversified mining companies in some of the base metals. If If you guys like this content, subscribe to the channel. Ride this commodity bull market up with me and everyone else on the channel. I can give these updates. You guys will be in the know of what's going on. And if these things start to rotate and turn, which I don't think they will, they're pretty slow moving, we can see it. But overall, all these ratios, they look incredibly good for a commodity bull market to continue. And I said to continue, which means we're already in it. We're in the early stages, maybe inning 1 or 2 of this bull market. And all you do is you sit in this stuff, you sit in it and wait, and let it make you money and let it go up. So that's kind of my viewpoint. I'm not really doing much. I'm not trading in and out. I'm just looking at where to deploy money, new money, continuously. And where I've been deploying new money is physical platinum. I've been buying physical platinum, and I've been buying a couple companies here and there, whether it be a uranium company here, a silver company there. A lot of smaller silver companies is what I've been buying recently. And that's kind of where I've been going. Subscribe to the channel, thumbs up. Thank you for listening. This is Finding Value.